What's going on, guys? It's Jordan de Jong here, and today I want to talk to you about how I'll be investing in this current economy. With the recent reactions of the coronavirus hitting all economies, monetary policy, and the consumer confidence, the voice in the back of our head starts to kick in and wonder if we should start to react in the same way and follow that same flock mentality. In all honesty, this is a very serious matter, and we don't know the full extent of the potential impact it may have. In no way throughout this video am I suggesting or proposing of taking advantage of a horrific situation. My first and primary objective is to stay safe and healthy and help the rest of the world do the same. But in times like these, it brings uneasiness about our investment decisions. We've recently seen this with global markets taking overnight shocks due to the population reacting to the spread of the virus. But these sort of emotional reactions aren't uncommon, and we've even seen some strong recovery already since those overnight falls. Thankfully, being property investors, our assets aren't as liquid as the stock market. We can't dramatically sell our properties tomorrow without a significant cost in reaction to market conditions. And with interest rates continuing to come down, it lowers that burden of holding costs to pay off our mortgage. This is the great safety net of our asset selection and is helpful in maintaining the current recovery in the property market. I can't see an immediate drop in property prices within the next couple of months, but that's not to say that consumer confidence won't soften over the next 12 months. There is so much speculation about the virus out there currently. Some are saying it's a man-made virus created to wipe out half the population, and others are saying it will just now become the fifth type of flu we experience seasonally. In no way am I an expert on the virus and have not conducted any research for this video, so this strategy will just be purely based on what I have learned about investing in various economic conditions. Warren Buffett has many iconic quotes, one of which is "Be fearful when others are greedy and be greedy when others are fearful." In simple terms, this means invest counter-cyclically, and this is the approach that I'm taking. We don't really know what is going to happen, so I'm preparing for a worst case scenario and market conditions to dramatically change. The property market has just come out of a market downturn caused by a series of events. In 2014, APRA required that all lenders must assess loans using either the greater of a 7% serviceability rate or a 2% buffer on that actual loan rate. This lowered borrowing capacity significantly, which means property buyers had less money they could borrow to purchase property. APRA also implemented restrictions on investor lending. In March 2017, APRA forced lenders to limit new interest-only lending to 30% of new home loans being issued. And on top of all this, ASIC cracked down on how lenders were assessing your HEM, which stands for Household Expenditure Measure, and is essentially your monthly living expenses. To top this all off, there was some serious concerns around the policy changes to negative gearing and the capital gains tax discount being proposed by the Labor government in the 2019 election. And if they had won the election, we would have been in a very different property market than we are today. In combination, this almost halted all property investors. Borrowing was tight, it was hard to get finance, and even if they managed to, they didn't know what types of assets to buy due to the proposed changes that might have come through after the election. This bottomed out the market around mid-2019, and we've seen a recovery since the election. Not only due to the Liberals retaining government, but APRA also lifted the 30% interest-only investor loan restraints on the 1st of January 2019, followed by removing the 7% assessment requirement on the 21st of May 2019, and ASIC lost a court case against Westpac on responsible lending in August 2019, giving lenders a little bit of hope. However, ASIC have since appealed this to the federal court. But the main recovery driver was the 3 interest rate cuts in late 2019, and now a 4th in March 2020, which reduces mortgage interest repayments and reduces the cost of holding our most expensive assets, which leads us to where we are now, with 5 of our capital city property markets at their all-time peaks. Also, if you're loving this content, make sure you smash that like button. The APRA changes in 2017 were needed, yes. The property market seemed to be growing out of control back then without any restraints, and someone had to step in. But looking back now, it makes you wonder if it was even worth the while. So, although this has been a long-winded backstory, I wanted to frame the mindsets of the property market now. There has been some huge pent-up demand from investors since 2017 to get back into the market. We've seen this surcharge come through in late 2019, but the problem really is the quality of stock on market. There's been a limited amount of stock on market altogether, and with this pent-up demand, it's no wonder that we've been seeing high clearance rates over recent weekends, which news outlets and property commentators all like to report on heavily. In turn, this distills consumer confidence back into the rest of the population about the property market. So this is where we're at. Really, up until the start of March 2020, consumer confidence is strong, borrowing money is cheap and slowly getting easier. There's plenty of pent-up demand for homeowners and investors alike to buy quality property. But then, almost overnight, the coronavirus has shocked the stock market and world economies. We can see this flock mentality start to kick in as the doomsdayers scramble to buy all the toilet paper in stores. It's too early to speculate if this is going to be an overnight reaction, a couple of months thing, or seriously impact the economy over the following years. All we know right now is that the vaccine is potentially 12 to 18 months away, and given the impact and the spread it's already flowed through China since it was discovered, we may be in it for the long haul. There are so many unknowns in this scenario right now, and if we take it back to Warren Buffett's quote, "Be fearful when others are greedy and be greedy when others are fearful." This is definitely a time where the economy is in a state of fear. We don't know how long it will last or the full impact it will have, but all we can do is prepare for it. I am a sit and hold investor. I never plan to sell any of my properties unless financial circumstances change and require me to do so. So for my existing investments, there'll be no movement. They'll sit there and ride out the waves regardless of how significant the values change. We've had a phenomenal run in Australia over the last 25 years. Set a record number of quarters of positive economic growth, and property values have continued on their growth trajectories even after the GFC. So even if property prices did fall for a period of say 5 years, I would still have hope of some sort of recovery after those economic conditions. However, with the current state of the property market being in a strong condition, I'm taking this opportunity to refinance my existing loans, pull out some equity and leave it in their offset accounts. This means that I'm not paying any more interest by pulling out that money because it remains in that offset. Although in the case where an opportunity did come up, I would have instant access to use that money sitting in the offset account if I needed to. And at that point where I use the money, I would then start paying interest on the additional borrowed monies. But by doing it now rather than later, we're utilizing the current market conditions to prepare for unknown future market conditions. If borrowing money became much harder at the time I wanted to take advantage of an opportunity, I might not be able to achieve the same results. And even worse, if the property prices had fallen, even if I could pull out more equity, I wouldn't be able to borrow as much as I could in a stronger market. Now, you may be thinking, well, the cash rate just came down again, and all the economists are talking about another one in April. Isn't this a good thing for the property market as interest rates keep coming down and it costs less to hold our property? Well, the immediate answer is yes. However, if you haven't read the RBA meeting minutes for the March cash rate drop, its pure focus is around the coronavirus and its impact on the economy. They aren't focusing on the property market right now. And when the RBA is concerned about the economy, so am I. Firstly, when the economy is down, consumer confidence reduces. People are reluctant to spend on luxury items and tend to save a lot more. This in turn leads to a reduction of economic activity. Essentially, less business transactions are occurring, but overheads remain the same, such as staff, building running costs, etc. So the business is ultimately making less profit. If this happens consistently over time, businesses try and stay afloat by cutting costs such as employees. If this is happening to multiple businesses in multiple industries all at the same time, it leads to a higher unemployment and underemployment in the economy. And this is ultimately what the RBA wants to avoid. They're reducing business costs by lowering their interest repayments before they make employees redundant. If a recession does occur when unemployment levels are rising and people are saving more rather than spending, the last thing on their minds is property being the most expensive asset. All they're worried about is putting food on the table and trying to find a new job. If you've been watching my other videos, you'll know how much of an impact supply and demand has on the housing market. And in this scenario, there's less demand overall in the market, potentially slowing down the growth of the housing sector or even seeing property values decrease. So although the property market may seem in high spirits right now, given the RBA's response to the current economic conditions, we may see a delayed flow-through effect as the population reacts to the coronavirus, essentially spending less money in the economy, leading to lower economic activity. This is why I'm getting my finances in order now, as there's so much uncertainty about how the property market will look amongst the spread of the virus and the economic reaction it may cause. How are you preparing to invest over the next 12 months? Leave it down in the comment section below. As always, seek your own professional financial, legal, taxation, and property investing advice for your current situation. These videos are just my opinion and are general in nature and should never be considered as personal advice. If you're keen for more content, make sure you subscribe and smash that notification button so you don't miss a video. And until next time, happy house hunting.